So both mutual funds and ETFs are baskets of investments. And so they're a basket of either bonds and or stocks that are pooled together. And so there's two different kinds of mutual funds. There's managed mutual funds and index mutual funds. In a managed mutual fund, there is a fund manager that is actively buying and selling stocks and or bonds in the mutual fund, trying to optimize performance to beat the market. Okay, those are typically more expensive because you have to pay this manager to do their job. Then there's also index mutual funds, and index mutual funds are a basket of stocks and or bonds that are bought and held to track a particular index or a particular sector, things like that, a particular section of the stock market or the bond market. So for example, the S&P 500 in an index fund, that fund would just buy the companies in the S&P 500 weighted to reflect what the S&P 500 actually looks like, and they just hold on to them. And those are less expensive because they don't have a manager having to pick the stocks or pick those and buy and sell within the fund. We like index funds better, and the major advantage of index funds is performance. So if you look over the last 20 years, actively managed mutual funds, which are more expensive because again, you're paying a manager, actually underperformed the indexes that they're compared to, the indexes they're trying to beat. 92% of the time, they only actually beat those indexes 8% of the time. So historically, it's been more effective to just buy an index mutual fund that reflects the actual index than pay more for these managed funds.
Well, it's kind of like when we found out about this several years ago, it's kind of like a light went off over my head. Because at that time, the number was around 80%. Only 20% of the mutual funds beat the indexes. And so all of a sudden the light that went off over my head was, wait a minute, if I just buy the indexes, I just beat 80% of the other mutual funds. And so that's pretty good.
So the same risk factors that we talked about with both stocks and bonds, of course, are going to apply to mutual funds because it depends on what underlying investments the mutual fund is in. If it's a stock mutual fund, then it's going to have the same risks that stocks have. But the major advantage of a mutual fund is that you have built-in diversification. So kind of like we talked about earlier that you need, maybe 15 or 20 stocks to diversify a portfolio. Well, there's many stocks in a stock mutual fund. So you have already spread the risk just in one stock mutual fund across many different companies. And
like hundreds.
Yeah, a lot of them have hundreds of companies. So you have all of this built-in diversification, and you can actually fully diversify a portfolio with only 3 to 6 mutual funds if you choose them right, which is really awesome and really simplifies things as well. So another thing that I wanted to touch on really quickly about mutual funds that's a little bit different as far as the pricing goes, because you can buy and sell mutual funds anytime during the market day, but you're not going to buy or sell them for the price at the time that you choose to buy or sell them. The price that you're going to get is an end of day price. And how it works with the pricing of mutual funds is at the end of the day, that mutual fund is going to add up all of the values, the end of day values of all of the stocks that they're invested in. And then they're going to divide that by the amount of shares in the mutual fund, the amount of people that have invested in it. And then that's how they're going to get their end of day price. And so if something is going on that's a market sensitive thing that you really want to get in or out, and a lot of other people have the same idea as you, you might be in for a little bit of a surprise at the end of the day.
You're going to get the end of the day price.
Yep.
So the other kind of category of pooled stocks or baskets of stocks that we wanted to talk about besides mutual funds are exchange traded funds. That's the abbreviation for that is ETFs. And so they're very much like these index mutual funds that we were talking about. There are some managed ETFs, but we don't deal with those. But the exchange traded funds are technically and legally structured as stocks themselves, not as mutual funds. And so they can trade any second of any business day, unlike a mutual fund that.
And you get the price at that second.
Yeah, so
that you
that's
buy
a
or
little bit
sell
of an
it.
advantage. You know, if you wanted to get in or get out of an ETF right now, you can do it right now because the market's open. If it's a mutual fund, you're going to get the end of the day price. The other thing, because they are trade like stocks, is you can place special orders on them, including a thing called a stop loss order. A stop loss order is an order that you place on a stock or an ETF that says, if the price drops to this price, I want to sell. They're kind of being like a parachute. So like if the price today is 100 and you're nervous that the stock market's going to have a big crash and you don't want to wait until after it goes down a bunch to get out, you could place a stop loss order at 95 that says that if the market price during a day gets down to 95, it sells you, and it sells you automatically. So those are two kind of little advantages. Another one that's an advantage is that you typically have lower expense ratios than most mutual funds. The risks of an exchange traded fund are generally the same as whatever the underlying investment is of the type of stocks that they are. They have the same benefits as mutual funds with stocks anyway, but without some of the drawbacks of being able to having to sell at the end of the day and that sort of thing. So